Hello everyone, welcome to Atomic ACCA's pre-mock exam solving series, and in this video we are going to look at section A of Audit and Assurance March 2025 exam. Now, the mentality that we have to keep when we approach these questions is once you start your exam, we need to finish section A questions as fast as possible. Now, we know mathematically speaking, there's 180 minutes, 3 hours, and 100 marks to score in the exam. So, we know the general rule that is 1.8 minutes per mark, but that we are not going to apply on the section A questions because we don't have any numericals or lengthy calculation questions within your section A unlike your other numerical papers like FR or FM. So what you have to do is if you keep the time limit of the general calculation 1.8 minutes per mark, it would be somewhere around 54 minutes that you will have for section A alone. But you don't need that much amount of time in order to crack this, which means the more time that you're going to save in section A, you're going to invest it in section B question because there the questions are going to be very lengthy. You will not be able to match up to that 1.8 minutes per mark calculation. So you will need time to think and structure your answer over there. So keep in mind section A as fast as possible. So first let's have a quick read over through the case study and figure out what all are the information given over here and then do one by one each questions after that. So Unihart Company, a listed company, is a multinational company operating in the technology sector. They provide software solutions to various industries, including finance, healthcare, manufacturing. Their statutory auditors are Alpha and Company. So we are from Alpha and Company, and our client is Unihart Company, and it's a listed company. All right. During the audit engagement for year-ended financial statement, the audit team encountered several ethical dilemmas. So this is related to ethical issues. Now, the engagement partner Sarah and the CFO of Unihart Corporation were college roommates and have remained friends over the years. Friends, engagement partner is the top person in the audit firm, CFO is the top person in the client company, and they are friends over the years, which means they have familiarity threat over here. Although, due to their busy schedule, they have not met as such over the recent time, they kept in touch at least once a month. Okay. During the audit, the team discovered that Unihart Corporation had overstated its revenue. So, client overstated its revenue by recognizing sales early. CFO requested, CFO is the head of the client company. Okay, they requested the auditors to overlook this issue. That means CFO is trying to manipulate the audit team, emphasizing that it was a one time occurrence and would influence the company's stock price negatively if disclosed. This is a material issue. Now they are giving already hints over here. Even if it's a one time occurrence thing, if it's a material thing, this needs to be adjusted. So early recognizing of revenue will cause the share price and all to be boosted, profits to be boosted. So not the right thing to do. Audit team received an invitation to attend a lavish dinner hosted by Unihart Corporation. So client is inviting the audit team. CFO assured that this was a gesture of appreciation for their hard work. However, the team wondered if accepting such gift would violate their independence. True. And it's very keen to note over here lavish dinner. So it's not a small gift, it is a large gift. You have to politely decline this. Alpha and Company, that is the audit firm, has identified that current year fees to be received from Unihart Corporation for audit and other services, which means they are providing audit and non audit services. It will represent 16% of the firm's total fee income and totaled 15.5% in the prior year. So in the last year and this year, it is going above the 15% threshold limit. So there are some ethical issues over here. CFO expressed urgency in finalizing the audit report to meet regulatory deadlines. So they are trying to pressurize, that is intimidation threat. So CFO is urging them. Then audit team felt pressured to wrap up quickly, even though some areas required additional scrutiny. Scrutiny means they need to find more evidences on those areas. Now, we understood what all is there in the case study, what all situations are there. Now let's start reading one by one each question. Question number 1 for this case study. What should Sarah, that is the engagement partner, do regarding her personal relationship with CFO? So we understood from case study they're friends since long years, so there is a strong familiarity threat over here. Number 1. Disclose the relationship to audit committee and seek guidance. Seems fine. Maintain confidentiality and proceed with the audit. Now, just because they have, familiarity threat, if they maintain confidentiality, it's simply about you're not letting the client's information get leaked out outside. But that's not going to solve the problem between their familiarity. Recuse or remove herself from the engagement. That is, the engagement partner can back themselves out from the engagement and stay away from it. They don't have to reject the audit or anything, but she can back away from that particular engagement. Now, that is possible. Accept the situation as common in the industry. That's definitely not okay. So, it's either one or three. Now, let's see if two options are possible. No, only one option is possible. So now we have to choose one or three is going to completely solve the problem of familiarity between friends. So let's say Sarah is there, CFO is there. Now, if they disclose the relationship to audit committee, does that mean that they both are not going to meet each other? No. They both are still part of this engagement. They both will still meet. They will have their shared opinions and things and all, which means if some problems comes up during the audit, this will automatically go to the senior management level, and the senior management from both sides are friends. They will discuss this, and this will cause the audit team to overlook most of the issues, or whatever audit risk or things they find out. This will have to be compromised during the audit, which means even if you disclose it to the audit committee and even if you see guidance from them, this is not going to completely cut off this problem of familiarity between these friends. But on the other hand, recuse or remove herself from the engagement. If Sarah moves away from the engagement and maybe some other engagement, or another partner comes on top of this, that means the audit will continue, everything will go smooth, the client will still remain as the client of the audit firm, everything is going well, and that familiarity threat is gone because they both are not going to meet each other anymore, which means much more than A, C will be the answer over here that's going to meet the conditions, or it is going to solve the familiarity problem. So we go with C in this question. Let's go to next one. Same case study, question number 2. What action should be taken by the audit team regarding the early recognition of revenue? So they told that the case study was telling due to early recognition, they don't want to change it because it's a material thing and it could affect the share price negatively. So, number one, ignore it as it will not influence the overall financial performance and position significantly. Wrong. It's already mentioned there, it's a material thing. So, if not recorded, it is going to influence the performance. So, option 1 is wrong. Report it to CFO but exclude it from the audit report. CFO is the one that is telling the auditors not to bother that particular revenue problem, which means if I go and report it to CFO, who is already telling me to not avoid that particular error, there is no point in reporting to them. So it's more like going and reporting to the thief itself, so no point in doing that. So option B is wrong. Adjust the financial statement to reflect the accurate revenue. Question was asking what action should be taken by the audit team. If in case question was what action should be taken by the client, then C is correct. They should go and adjust the financial statement. But as an auditor, I am only supposed to guide the guide the client company on how to correct the financial statements, what is the correct accounting standard. But I am not supposed to involve in making that financial statement. So adjusting the financial statement is the work of the client and not of the auditor. Considering that 1, 2, 3 is wrong, by default, fourth one is the answer, but let's have a read through it. Report it to the appropriate level of management and those charged with governance and request they correct the misstatement. So that looks fine, and that will be your answer. Third question. Regarding the invitation to lavish dinner, which of the following are threats to auditors' objectivity that may arise? Now that's a quite straightforward one. Self-interest threat will be there because you're going to have no self-interest means because there's a lavish gift coming in, you will have a thing as an auditor that okay, I have to be inclined towards that client company, I have to make them happy, I should not find a lot of mistakes so that every time I can get this client and every time I can get lavish dinner and all. So there will be that self-interest problem over here, you will be kind of biased towards the client company. One is correct. Now before going into the next ones, 1 and 2 is there, 1 and 3 is there. So 2 and 3 is not going to work, 2 and 4 is not going to work. So it's either 1 and 2 or 1 and 3, which means automatically fourth one is not an answer over here. Now I have to find out whether it's 2 or 3 because I can't choose two of it. So it's either 1 and 2 or 1 and 3. Let's read the second one. Self review threat. Now, just because I'm getting a lavish dinner, there's no review of self work that is happening, because self review means you're reviewing your own work. Like that, no, nothing is happening over here, which means by default, self review is not the answer over here. So 1 and 2 will not work. So what is remaining? 1 and 3. So this will be our answer. What is the third one? Familiarity threat. Just because you have lavish dinner with the client, that means automatically you will get more familiar with them. You will have more connection built with them, because this is not a formal event. It's an informal event happening outside of the company. So automatically your relationship will build with that particular client, and that will cause a familiarity threat in the future years. Next question. Which of the following safeguards would not be relevant in mitigating the threat identified with regards to fees? So they're asking which will not be relevant. So either you can find what's not relevant or cancel out all the relevant things. So the remaining one will be the answer. So disclosure to those charged with governance that fees from Unihard company represent more than 15% of Alpha company's total fee income. So you should be disclosing it to those charged with governance. Okay, that is correct. A pre-issuance review to be conducted by an external accountant. Pre-issuance review means before issuing the audit report, a review is being done whether the audit was done with proper quality or not. So it's like a quality control that is being done before the audit report is finalized. So that is also okay. Use of separate teams to provide the audit and non-audit services. Now, regardless of who does that audit or non-audit service, whether it's the same team or a different team, it's not going to solve the problem about fee income. Here it's not about whether self review threat is there or not. It's not about self review where same team is going and doing the audit and non audit service. In that case, we can solve the problem out by splitting the team so that the same team will not be reviewing their work over and over again. But here the problem is about fees and your inclination towards that client company, because when more fees is there, you will tend to be obliged to them. You will have that kind of sense of belongingness to them. Whatever errors they are doing will not solve that out. Now this will not be solved out regardless of who is doing the work, because still in the end money is coming to your to the audit company itself. In that case, C will not be an answer over here. It's not a safeguard to clear this out. Question was asking what is not a relevant item. That means C is the answer over here. Can we choose 2? No, only C is the answer. Last one, assign an engagement quality controller review. So that's like connected to the second point, again checking whether the audit quality was done properly or not. So we found the answer, that is third one. Then moving to next question. Unihard company, okay, it's the same one. CFO of the client company has expressed urgency in finalizing the audit report to meet regulatory deadline. Audit team felt pressure to wrap up quickly, even though some areas needed additional scrutiny. As an auditor, which of the following would be the most appropriate safeguard to mitigate this threat? So what is the threat over here? It is an intimidation threat coming from the client company in order to finish the audit faster. So they're asking most appropriate safeguard. So what is the right thing to do? Number one, agree with the CFO and quicken the audit process to meet the deadline. Definitely no. Resign from the audit engagement due to the pressure from CFO. Now we have told during our lectures that whenever a threat, whenever a safeguard is to be told, don't go into the extreme situation first itself where you're going to resign the audit completely. Rather, because audit firm is a business in the end, client is a customer, the business never wants to lose a customer right away if something goes wrong. Rather, they'll try to put some limitations or some restrictions in order to make sure that things are under control. Only if things go out of control and you think that this is not going to work at all, then the last option is resigning. So first option, in order to mitigate the threat, is definitely not resigning from that audit engagement completely. So option B is wrong. Audit partner should politely inform the finance director that team would undertake the audit in accordance with all relevant professional standard and quality management procedures. So if you have practiced some section B questions related to ethics, that box question, you might have come across the same sentence over there itself. There also about what safeguard we'll do. We'll politely tell them that we're going to follow the audit guidelines, we are going to do all the proper standards, we are going to find out proper evidences, only then we can go ahead with the audit. So time negotiation will be done, we need extended time to complete the work properly. So C will be the right answer over here. Let's read the last one. Reduce the size of sample that the audit plan to test on so that the work is completed within the required deadline. Wrong. If you reduce the sample, you will not be able to find out proper problems that are there within the financial statement. So 1, 2 and 4 is wrong. So 3 will be the answer. So we got our answers for this question. Let's move to next one. So Unihard company is done. So 5 questions from case study 1 is over. Let's move to case study number 2. So let's read the case study. It is 1st July 20x5. You are an audit manager at 7 Kings and Company. So this is the audit company. Okay. Responsible for the audit of Sam Sing Song Company. Okay, let's just call it S Company for the year ended 30th April 20x5. Samsung is a manufacturing company that produces electronic gadgets. The audit is almost complete and financial statements are due to be signed shortly. Okay. On 1st May 20x5. Year end is 30th April. So 1st May is like the next day after this. Client received notice of a lawsuit from a competitor alleging patent infringement. Means you basically copied your competitor and did something. The potential financial impact is uncertain, but it is likely to be material figure. Okay. Management, after consulting with their legal counsel, has decided to disclose the lawsuit in the notes to financial statement. So only disclosure is needed, as the outcome is possible, not probable, that they might lose in the lawsuit. So we know according to IS 37 provisions, contingent asset and liability, when the payment is only a possible situation to happen, and if it is material, you need to only disclose it, you don't have to show it in your financial statement. So no adjustment is needed. Then this has been confirmed by the audit team through direct confirmation from the client lawyers. Previously, client is consulting with the legal counsel and confirm this, and the same thing audit team also confirm with the client's lawyers. What does direct confirmation mean? They didn't take a confirmation from the client company about what legal counsel told, rather they contacted the lawyer directly and got a confirmation that this is only a possible situation, so which means disclosure is correct, there's no accounting problem over there. On 15 May 20x5, so this is also after year end, but 2 weeks later, client's management discovered a material fraud. The word meaning of material means it is something to be shown within the financial statement. Either it could be within the adjustments or it could be through the disclosure. But whatsoever it is, material things should always be there in the FS. Now, the CFO had been inflating revenue by recording fictitious sales, fake sales. Fraud had been ongoing for the past 6 months. When did they find this? 2 weeks from year end. Past 6 months means through the financial year this fraud was going on, which means at the reporting date whatever revenue is being recorded, this is a boosted figure, this is a wrong figure, because fake sales are recorded within this, because past 6 months data is corrupted now and has resulted in significant manipulation of financial statement. Okay, this also had led to incorrect decisions being made on the inflated financial statement, such as taking on additional debt that the company is now struggling to service. Struggling to service means they're not able to repay the interest payments properly on time, because debt was taken by showing to the bank an inflated financial statement which is not their actual performance. Legal proceedings have commenced against the employee responsible and their final wages have been withheld. Okay. Client faces financial strain due to declining sales and increased competition. Their liquidity position is worsening and they have defaulted on last 3 payments. Defaulted on last 3 payment means whatever payments they were supposed to clear to the supplier, 3 deadlines have been passed and they were not being able to clear it. So 3 payments have been defaulted. The board of directors is concerned about the company's ability to continue as a going concern. So survival problems are there. So we understood the case study, what all are there in different paragraph. Now let's read the questions one by one and see what are the situation. What type of subsequent event should the material fraud discovery be classified as? So year end is 30th April. You found this 2 weeks later, which is a material fraud that has been happening through the year. So whenever an event is found out post year end and it has some source of evidence through the year, and during at the reporting date the FS is created and it has some impact on it, which means this is always an adjusting event. If in case it's a new event that is happening over here and it has nothing to connect with the financial year or the financial statement, then it is a non-adjusting event. So over here, this is a adjusting event. It's not a non-adjusting event because we already explained what that is. Going concern event, it's not very much understandable. It's a material fraud, figures are big, but there's no clarity about whether that particular fraud is going to lead to a going concern issue, because this is simply about a material fraud of boosting revenue. So that's not exactly a going concern indicator directly. Legal event, there's nothing as such, because this particular event alone is not going to lead to a legal issue. There are many other things as well. Legal issue previously was also caused because of no patent infringement. So there's no specific thing called as legal event. So it's either to choose between adjusting or non-adjusting over here. So that one is done. Which of the following statements is not correct about the auditor's report on client's financial statement? Which of the following statement is not correct about the auditor's report on financial statement? Okay. Audit report must include an opinion on whether the financial statements present fairly in all material respect in the financial position and performance of the entity. That's basically the idea about what does audit opinion mean. Correct. Auditor's report includes a paragraph that outlines auditor's responsibility regarding other information in the report that contains the audited financial statement. Okay, auditor's responsibility, the client's responsibility, all of these things are supposed to be there in the audit report. That is also fine. Auditor's report must include an emphasis of matter paragraph that highlights a matter that has been correctly disclosed in the financial statement. Things disclosed in financial statement is highlighted in emphasis of matter paragraph. That is okay. But audit report must include is not mandatory. If auditors want to disclose it or auditors want to highlight something, they can do it if they want to. If they don't want to, they don't have to do it. So that must include doesn't seem to be right, but we'll keep that on hold because the question was asking about which is not correct. Option 1 and 2 is anyways correct. Option 3 is kind of doubtful. We'll see option 4 whether it's correct or not. If it is correct, then by default option 3 becomes the wrong one. Option 4, key audit matters are included in the auditor's report of listed companies. That is correct. Key audit matters are only mandatory for listed companies. For non-listed companies, it's not mandatory. So in this case, 1, 2 and 4 becomes correct. So by default, we understood what is the reason for that. Option C is not correct. So that will be the answer over here. Going to next one. Which of the following would be the key consideration by auditors when evaluating the appropriateness of management's assessment on going concern? Key consideration by auditors when evaluating the appropriateness of client's assessment on going concern. Okay. Company's current year's financial performance. Current year figure is not going to give you a lot of information about what's going to happen in future. So that's wrong. That is partially an indicator, but that's not completely the key indicator. It's not the key consideration. Then company's historical profitability trend, what happened in the past also will give you some indications only about how things are going about, but not a proper clarity about what's in future. So not option B either. Company's ability to continue operations for the foreseeable future, about future it is, so this could be the answer. Last one, company's liquidity ratios in comparison with industry average. Comparing with industry average will give you an idea whether you're doing good or not, but not exactly whether you can survive or not. That is one problem. Secondly, liquidity ratio is about checking whether the company is able to meet their short term obligations. If you look at the formula, it's current asset by current liability, meaning can you clear off your current liability, your short term obligations with your current assets. So liquidity ratio is not talking about long term obligations or long term future, they're just talking about the short term indications. So even if liquidity ratio is bad, it's not going to completely indicate that going concern problem is there, because it's only about a short term thing. So option D is also not the answer. So by default, option C will become our answer. That is checking about the foreseeable future, how they can continue the operation. Next, given the management's decision to only disclose the lawsuit in the notes to financial statement without making any provision for potential liability, what will be the impact on auditor's report? Now we already discussed this point while reading. Client went to the to the legal counsel and confirmed that it is only possible. Auditors also got a direct confirmation from the legal advisor that this is only possible, which means only disclosure is needed. No need to make any provision or liability within the financial statement, which means by making a decision to only disclose lawsuit in the notes to financial statement without making any provision, there is no problem in the financial statements because everything is proper. This is a material thing, they have disclosed it, it is in accordance with accounting standard, so financial statement has no error. So issue an unqualified opinion with an emphasis of matter paragraph. Okay, unqualified opinion because financial statement is correct. Emphasis of matter paragraph, will keep on hold on that. Let's see the other ones. Issue a qualified opinion. Qualified opinion is issued when there is some material problems, so that is wrong because financial statement is correct anyways. Adverse opinion is issued when financial statement has material and pervasive problem, so that is also wrong. Issue a disclaimer of opinion. Disclaimer of opinion is when there is material and pervasive issue about things that you can't find evidences about, and that is too large. But here that also has no problem because you got a direct confirmation from the legal advisor. So B, C, D is wrong, so option A becomes the answer. Issue an unqualified opinion because no problem is there in the financial statement. Emphasis of matter paragraph in order to highlight the thing that is already disclosed within the disclosure note. So that will be the answer over here. Next one. After conducting procedures on going concern indicators like the additional debt that client is struggling to service, financial strain due to declining sales and increased competition, and the notice of a lawsuit from competitor, the engagement partner has concluded that there are material uncertainty relating to going concern that needs to be disclosed in the financial statement. Which of the following statements regarding the impact of this disclosure on the audit report is correct? So the whole thing is about going concern issue is there. They are ready to make disclosures in the financial statement. Question is asking, if they made those disclosures in the financial statement, what will be the impact on audit report? So we know that very specifically to going concern uncertainties, within the audit report we have a special paragraph that's going to indicate or direct to this disclosure about going concern uncertainty, which is called as MURGC, material uncertainty related to going concern paragraph. So it's a direct technical question. Audit report must include this one paragraph about that particular disclosure, and if they have disclosed it already, it means that audit report is correct, so financial statements have no problem. It will be an unqualified opinion. Unqualified opinion, okay, not unqualified report. It will be a modified report because some extra paragraph is used, that is the MURGC. But an unqualified opinion will be there because financial statement is all correct, all disclosures are made properly. So an unmodified audit report, here itself it went wrong. It will be a modified audit report because new paragraph is to be used. So there itself it went wrong, but let's read the remaining. Will be issued if management correctly and adequately discloses the material uncertainty related to going concern. So that is wrong. An adverse opinion will be given. Adverse opinion means if in case they did not disclose it, then material uncertainty is a major event and they decided to not disclose some major things within the disclosure note, then it can be an adverse opinion. But here they are ready to do the disclosure, which means financial statement has no problem, so adverse opinion will not match over there. But let's read the remaining thing. Will be given in the audit report if management correctly gives the disclosure in financial statement as going concern is a matter that is fundamental to users understanding of financial statement. No, so adverse opinion will not match here. An unqualified audit opinion. Unqualified audit opinion, previous one was unmodified audit report, that is wrong. Unqualified audit opinion is correct. Will be given if management correctly and adequately discloses the material uncertainty related to going concern in FS and an emphasis of matter section will be added to audit report. That is wrong. We know that there are three additional paragraphs that will be used. One is MURGC. This will connect to the disclosures about material uncertainty related to going concern that are there in the disclosures. Emphasis of matter paragraph will connect to the disclosures that are already there apart from going concern disclosures. So anything about going concern disclosure, MURGC. Anything apart from going concern disclosure, emphasis of matter paragraph. So here this is about going concern issue, so we cannot use the emphasis of matter paragraph, so option C is also wrong. Last one, an unqualified audit opinion, correct, will be given if management correctly and adequately discloses the uncertainty about going concern in FS, and a material uncertainty related to going concern section will be added. So this will be our answer as explained earlier. So that will be the answer for this particular question. Okay, Carlos company. I think the case study changed. Previous one was Seven's company. Okay, so case study 2 is over. So we are now on to case study number 3. We have 5 more questions in our section A. It is 1st July 20x5. You are an audit supervisor of Roberto and Company conducting the audit of Carlos for the year ended 30th September 20x5. So 30th September x5, 1st July x5. Okay, so you are in the process of conducting the audit. Carlo operates a number of hotels providing accommodation, leisure facility and restaurants. Several matters have come to your attention. Okay. Leisure facilities upgrade. During the year, Carlos made significant asset expenditure to update the leisure facilities at several of its hotel. Significant asset expenditure. So capital expenditures are there. Company acquired new gym equipment. Okay. Renovated swimming pools and expanded the spa services. These non-current assets are critical for attracting the guest and maintaining the company's competitive edge. That means it's all part of the non-current asset. These are supposed to be capitalized. All right. Food poisoning allegation. There have been allegations of food poisoning from customers who visited one of Carlos' restaurants. Some customers are claiming substantial damages due to illness caused by the contaminated food. The legal team is actively handling these claims and the financial impact could be significant. So this is something related to provisions and all. Maybe some accounting standard about IS 37 or rules related to that could be there to apply. Inventory management system upgrade. Carlos recently upgraded its inventory management system. New system aims to improve accuracy in recording the inventory transaction. New system aims to improve accuracy. Okay, that is about valuing in inventory transactions, including the purchases, usage, and disposal. That means when some items are coming in, items are being sold out, items are being used, everything will be accurately recorded by this new system. However, there are concerns about the effectiveness of the implementation, meaning that new system has just come into existence into the company. So it is yet to be operating properly. So there are some concerns about the effectiveness and whether the system is accurately reflecting the physical inventory level, which means the new system's aim is to do all these things, but because it's a new system, there are some concerns about whether it's working properly or not. So that's the third paragraph. Fourth one, trade receivables confirmation. Audit team has obtained result from the external confirmation of a sample of trade receivable. Sample of trade receivable, you got an external confirmation from who will give external confirmation? Customer basically. So for a sample of trade receivable, you got confirmation from outsiders. That means it's basically like you're checking the existence, whether these receivables are actually existing or not. Then depreciation of non-current asset. Carlos depreciates its non-current asset over their estimated life. Company uses straight line depreciation for building, furniture and equipment. All right. So we understood the case study part, what all are the information given. Let's read the questions one by one. Which of the following audit procedures would be most relevant for evaluating the existence assertion? Existence means things that are there in the financial statement is actually physically there. It's not a bluffed up item in the financial statement. It's actually there for the company. Related to the expenditure on leisure facilities upgrade. So that is about the first paragraph. Some capital expenditures were done. They're asking what audit procedure will be helpful in finding the existence of these items. So simply it will be like you're going to check a sample of items within the financial statement and check whether these are actually present or not. So let's read the one by one. Take a sample of physical assets and ensure that they have been recorded in the asset register. So this is like opposite. You're taking a sample of physical asset and checking whether the recording is done properly. This is completeness, not existence. So option 1 is out. Compare the current year's leisure facility expenditure with prior year expenditure to identify significant fluctuation. Now, definitely you can get the fluctuation figures and all. You can figure out how much money was spent, how much increase or decrease happened. But that is only between comparing the data in the financial statement. This is not going to give you an idea about whether these numbers are actually true, whether the assets are actually physically there or not. So this is not going to give you an idea about existence. Third one, visit the hotels and physically inspecting the newly acquired gym equipment, renovated swimming pool, and expanded spa service. This will give you the idea about existence, because things that are there in the financial statement, when you're visiting there, and if you don't find it, it means that it is not existing. And if you find it, it is existing. So option C will be the answer. But let's read the last one as well. Review the invoices from the suppliers and contractors to verify they are in Carlos' name. Now, if you look at the documents and see if it is in Carlos' name, this will only give you an idea about whether these are owned by Carlos or not. That means this is going to give you the assertion about rights and obligation, and it is not about existence. So option D is also not the answer. That means option C is our final answer. During the audit of Carlos, you discover that there have been allegations of food poisoning from customers who visited one of their restaurants. Some customers are claiming damages due to illness caused by contaminated food. Legal team is actively okay. All that was from case study. Which of the following audit procedures would be most relevant in gathering sufficient appropriate evidence regarding this issue? So they just told sufficient appropriate evidence. They didn't specifically tell any assertion over here. So what you have to see over here is not anything about assertion. You have to see overall related to a legal case that is going on. How will I get the maximum amount of evidence, which will be most reliable out of this? So that is what I'm going to picture or take out of these options. So I don't think I can take multiple options, so it will be anyone. Okay. Reviewing the legal correspondence and settlement agreements relating to the food poisoning claim. Legal correspondence means communication that's happening between the legal authorities. Settlement agreements, that is about the discussion that's happening either between the customers or between the legal authority. So this seems partially okay, but let's see if the others are better than this point. Inspecting the restaurant's kitchen facilities and hygiene practices to ensure that they have been improved. Now, whether they have improved or not is part of their control maintenance. But this is not going to give me any idea about what this legal case is going to be. Just because they improve their kitchen doesn't mean that a court will say that, okay, no problem, everything is sorted out. No. So if I go and check the kitchen whether things are proper or not, this will not give me any idea about the legal case. So option B is out. Vouching sales transaction. Vouching means inspecting the sales document transaction from the restaurant's cash register. This will give me an idea about how much revenue was recorded, how much sales was done, etc. etc. And this will give me only an idea about how the cash register is recorded and things and all. But again, nothing related to the legal case at all, because this has nothing to do with the legal authorities. So option C is out. Confirming the balance of accounts payable with food supplier. Now this is only going to give me an idea about what payable figure I have towards my supplier, but nothing related to what I have to pay to the customer or what is going on with the legal case. This is quite straightforward that option 1 will be the answer, because this is the only one that is giving me some idea about what is going on with this legal case over here. So option 1 is the answer. Next, Carlos has recently upgraded its inventory management system. Which of the following procedures would be most appropriate to assess the design and operating effectiveness of this new system? So first thing, which procedure is most appropriate? So they're not asking you to exactly figure out which assertion or anything. Secondly, they don't want to figure out whether this is completely giving out some numbers or so. Rather, they're specifically asking you two things. You have to always be careful with the conjunctions to assess the design and operating effectiveness of this new system. So both needs to be addressed over here. So let's read one by one. Review the system documentation. System documentation means there will be like a manual about what the system is, how it is operated, what inputs are to be put in, what outputs will come out, what is the overall maintenance situation. So like a manual, system manual, that's called system documentation, to understand the design of the new system and the controls incorporated into it, and document. So design of the new system, what all controls are there, will give me some idea about how good this will operate. But again, we'll keep that on hold. Let's see the other ones, whether that could be better than this. Perform test of detail on a sample of inventory transaction recorded in the new system. So if I look at sample of inventory transactions and do a test of detail, this will give me whether the figures are coming out correct or not. That means operating effectiveness to some extent I can figure it out, but I can't get any idea about the overall design of the inventory management system. So option B will not work out. Conduct a physical verification of the inventory at the year end and compare it with the system records. So one part of this particular, where is that paragraph? That last line over here. The However, there are concerns about the effectiveness of implementation and whether the system is accurately reflecting the physical inventory level. So what we are doing, a physical verification of the inventory. We're going to the warehouse and checking how much inventory is there and comparing with the system record and seeing how much is being recorded there. Now, this will give me a clarification about whether that new system is recording the physical inventory level correct or not. Again, that is going to give me an idea about the operating effectiveness, whether this is working properly or not. But this is not going to give me any idea about the design. Plus, it's only giving me an operating effectiveness specifically about that physical inventory level count. There were more other things, whether they are recording properly about how much transactions is being done, how much purchase is being done, how the usage is being recorded, how disposals are being recorded. None of this is being found out in the second and third paragraph. I'm sorry, second and third procedures. So 2 and 3 is out. Perform analytical procedures to compare the inventory turnover ratios before and after the system upgrade. Inventory turnover ratio means within a particular time period, how much times are you able to sell your product. But whether you're able to sell the product or whether you're not able to sell the product, this was not the idea behind having that inventory management system, because your plan was not to enhance the sales just by implementing this new system. Your plan was to record the inventory values properly. So option D is not going to give me any idea about whether the system is working properly or not, because it's not directly connected to sales at all. So option B, C, D is wrong. So by default, option A will be correct. Once again, reading through this, what are we checking? We're looking at the systems manual to understand the design of the system. So this part is okay. Controls incorporated into it, which will give an overall idea about whether every operations within that particular system will be effectively working out or not. So that question is also done. Then, oops. During the audit of Carlos, the audit team obtained external confirmation from customers to assess trade receivable. Which assertion is primarily addressed by this procedure? This we already told. The point was very clear from here. Audit team has obtained result from external confirmation from those customers of a sample of receivable. So you didn't take sample of customers and checked whether this is correct or not. Rather, you took a sample of receivables and got external confirmation from the customer. So audit team is getting external confirmation about the receivables from a sample of this, which means this is going to confirm your existence, whether these receivables that are recorded within the books, this is actually there or not. That's why you're taking external confirmation from people. Completeness, anyways, it would be the opposite way around, so that's not going to work out. Valuation is specifically about the amount. Now, in order to get the amount specifically, rather than contacting the customer, let's say for example I contact the customer, client has recorded, let's say 100,000, client is saying no, I have to pay only 70,000. Now just because they tell it 70,000, should I completely trust on this? Not exactly. I would rather go check the sales invoices that were done to that particular customer. I would check the bank transactions that were done from their end and see whether the figures are matching out and whether that 70,000 which customer is telling is actually correct or not, or whether the 100,000 recorded by the client is actually correct. So because it's not always that client is going to make the mistake in accounting, it could be the customer also that's doing the wrong accounting as well. So both sides mistake could happen, so I need to get more evidences to see whether the value is correct. So getting an external confirmation from customer alone, I'm not going to trust it completely whether the value is correct or not. So this particular external confirmation will not give me exactly the idea about valuations. Finally, cutoff. Cutoff is related to the time period, and cutoff is an assertion generally related to SOPL items and not SOFP items. So this will also not work out over here, which means existence is our answer. Did we select the correct one? Existence. Oh, okay. Then, which of the following audit procedures would be most effective in assessing the reasonableness of Carlos straight line depreciation for its non-current asset? So what are we trying to find out? Be careful. Reasonableness for the client to use a straight line depreciation. So we're checking whether straight line depreciation is good for that client company to do or not. Not like good in the sense about, financially good. We're talking about whether this is the right thing to do, whether or should they move into a reducing balance method like that. So first one, select a sample of non-current asset additions that is there in the financial statement and trace them back to the original purchase invoices to verify the accuracy of the recorded cost and useful life. This will give an idea about whether depreciation is recorded correctly or not. But what are we actually trying to find out? The reasonableness of whether using that straight line depreciation is correct or not. I don't want value about depreciation is correct or not. I want to see why a straight line depreciation policy is used. So first one will give me idea about the depreciation value, but I don't want that over here. That's not my motive through doing the procedures. So first one is wrong. Second one, compare the current year's depreciation expense with prior year expense and the industry benchmarks to identify any significant fluctuation. So if I look at the current year expense, it's based on straight line depreciation. If I look at the prior year expense, I'll get an idea whether that was also on straight line depreciation or whether it was under some other policy. If I look at the industry benchmark, I'll get an idea about whether generally my competitors in the industry are using a straight line depreciation for similar assets or a reducing balance for similar asset. If the depreciation numbers are significantly different, then this could be a little bit of an indicator that okay, straight line depreciation policy is specifically used maybe in order to reduce down the expenses in SOPL, something like that. So this will give us some idea about whether that straight line depreciation policy is the right one to use or not. But let's not finalize it. Let's see the other 2 points as well and see whether that one is correct. Physically inspect a sample of non-current asset to ensure they are in use and assess their condition. Now, if I go to a particular place, I see the particular non-current assets and if they're using it or not, however they're using it, is not going to give me exactly an idea about whether straight line depreciation or reducing balance is the right one to do over there, because it could be an idle asset, it could be an asset that is very heavily used, it could be an asset that is moderately used. That's not going to give me any idea on one physical visit which kind of depreciation policy they have to use. That's more or less going to give me only an idea about uh, you know let's say I can figure out what could be the useful life of the asset maybe, but again whether that policy is to be used or not, I will not get an idea. Plus, if I'm going and physically inspecting it, I can get an idea about the existence of those assets as well. So not option C. Last one, send confirmation request to suppliers and service providers to verify the terms and conditions of any maintenance contract related to non-current asset. A maintenance contract about non-current asset, suppliers confirmation, this might give you an idea about what all maintenance expenses could come up later on, or it could give you some idea about what could be the useful life of the asset. But again, this will not give the exact idea about why Carlos company is using a straight line depreciation policy or their reasonableness for using this. So option D will also not give you an exact idea about why straight line depreciation is used. So with that being said, our option 2 will be the answer over here. Moving to next one. Okay, that is it. So section A questions are all done. We're done with 3 case studies into 5 questions each. So that's altogether 15 questions multiplied by 2. So 30 marks worth of section A is completely done. As said in the beginning of this video, you have to be as fast as possible in order to cover these questions, because whatever time you save in section A, that's going to be a bonus for you in order to use it in your section B questions. Hope you have followed with the way and the techniques of how we go through section A questions and crack it as fast as possible. Make sure to apply this, and if it is helpful, during your exams as well. See you in the next video. Bye bye.